Okay, so what is the moral hazard here? If I'm the manager, okay, this company is not mine, right? It's owned by somebody else, and I was paid by salary. Why should I care the company is doing well or not? I'm gonna play video games every day, okay? So I got paid $150 million every year. I'm gonna play video games. If the company is not doing well, too bad for Disney owners, for those investors. I still got paid the salary, right? Okay, so when I signed the contract, they promised me that they're gonna pay me $150 million, and I promised them I'm gonna work hard. Okay, I will work really, really hard. I will only sleep 2 hours a day. But my future action, they will not see, right? They won't send a spy, install cameras in my office, checking on me if I'm doing the job. Okay, so the moral hazard is I'm not gonna work in the best interest of the investors and owners. Okay, so this is called agency and principle problem. How are we gonna deal with this problem? This is moral hazard, right? So basically, the owner is saying, okay, I understand this problem. Guess what? I'm gonna tie your pay with the performance of the company. If the share price reached $100, you will get a bonus. If it's reached $200, you get another bonus, right? You can see that the negative consequence will be, the risk of the negative consequence will be shared by the two parties. If it's only salary, the company bankrupted, so I still get 150 millions. But your salary is zero. Your pay is based on shares. I will give you $1 million, 1 million shares. If you are not running the company well, the company's stock price plumped, then your pay will be reduced, right? So you can see this performance-based contract is a way to solve the agency and the principal problem. For the banks, right? So the the banks and the firms, right? The firms borrow the money from the bank, right? They decide to go crazy, right? They take extreme risks, and they invest in very, very risky areas. Guess what? If that money is lost, the bank will lose it. I will declare bankruptcy. So that's why the bank will have a specific covenant to make sure that the company is not going crazy, right? So in the intro level courses, you learn about debt covenant, right? When the company reaches certain level of debt, they will not get more loans, right? You have learned about debt covenant, the total debt divided by total asset, right? That's your debt covenant. If your debt covenant is debt to equity ratio is very high, the bank doesn't like it, right? So that's how they use these different ways to address these moral hazard problems, okay? Because it's bank's money, you are very careless investing the money. So the bank has a way to deal with it, okay? So do we have any questions? So for adverse selection, you're gonna use costly signaling, okay? Costly signaling to avoid adverse selection. And for moral hazard, you have to use incentive pay for measuring performance, and you have to use different terms contract to address the highly leveraged companies. So any questions?
So what about if...
Sorry, I can't hear you. Could you please speak up a little bit?
Hello?
Hello, am I speaking to?
So like to overcome moral hazard, what about like the negative stuff that an employer might do? Would this also count, like having video cameras everywhere or monitoring your screen?
Okay, yeah. So what happens is that we have performance evaluation, right? For most companies, they can unless it's a bank or some kind of special industry, they are able to install a camera behind the employees to monitor their work. Right? For banks, they have good reasons for doing that. But for most industries, I think it's against the human rights or something like that, right? The companies, HRs, they are not allowed to do that. I don't know. I'm not a lawyer, so I'm just speculating. But then the company have different ways to deal with it. For example, they would have performance evaluation, right? So at the end of the year, if you use the social medias all day long, right? You don't perform, it's gonna hurt your performance. And then at the end of the year, they're gonna evaluate your performance, and they will decide whether they're gonna kick you off. They're gonna kick you out, or whether they're gonna give you a good raise, right? The annual raise could be 6%, right? I remember when I was in a public accounting firm. Every year we have performance evaluations. The good students will get a very good raise, like 12%, okay? Because they are not paying a lot to start with, right? So they can afford to give you good raise, like 12%. For those of you who are not doing really well, they give you like a 2%, like only for the inflation to compensate for the inflation. So the company have ways to deal with the employees in terms of the moral hazard. Yeah.
Yeah, I just want to add to what she said. I saw you just make a suggestion to what she said. Sometimes the camera may not work, and like you said, something like a target, for evaluation, that's a PA, can be used, because I can sit on the system, for 8 hours, and there's someone that can just come in for 1 hour and even achieve more than me. And that can also be creative, that can even add more value than someone can be diligent and not, adding value, not creative. So most times, what companies can do is to set a target, and it doesn't matter how many times you spend at work, but so far you can achieve the target, and you can, increase the weight of the shareholders, so they are okay with you instead of putting camera. Thank you.
Yeah, very good. So so the companies is also going to use the benchmarks, right? The performance target, for sure. Yeah, it's not just for CEOs, right? It's also for example, in the accounting firms, sometimes they will use billable hours, right, as a target. So they will set up a target of, let's say, 70% your time available. That's a target, right? So for students, they are putting the effort, but guess what? That effort is not translating into money. So you can work very hard, but if your effort is not available, so you are not translating that effort into dollar, right? So then the company is not getting the economic benefit. So that's why they put a target of 70% of time. Okay, so they are hoping if you work 8 hours a day, at least 5 hours, 6 hours that are available. So you are making money for the company for that. Very good. So the targeting is also, the company also use that to monitor the employees. Okay, we'll keep going. So moral hazard, that we talk about the cost of moral hazard, right? So the most recent one, the big one we all know is this 2008 financial crisis, right? 2008 financial crisis started in United States, subprime financial crisis, right? So what happened is, so this there are three parties, right? You have the buyers, right? The house buyers, they want to have a house, right? And then you have the banks, right? The banks will give out the mortgages to these house buyers. And then what happened is there is the third party, the investor. So the bank will package all these mortgages together to sell it in the form of securities to investors. Okay? And then the investors, they will kind of get insurance, okay? Because it's risky, right, to buy this mortgage-backed securities. So then the investors will get get insurance, right? So now you can see this whole issue, right? The moral hazard. The bank doesn't care, right? Right? They will sell it to the investor. If the buyers is not really qualified applicant and they default in the future, the bank does not take that consequence. The investors will take that consequence, right? Negative consequence. And the investors doesn't care because they have insurance. They buy insurance. So if the securities have issues, the insurance companies will cover for that. Okay. So then you can see that the bankers, the risk is essentially passed to the insurance companies, right? The bankers, lenders are very careless. So in fact, it's crazy how careless they are. So how careless? So they give out the loans called the Ninja loan. Ninja, Ninja loans. What does this mean? So Ninja, it means, okay, I will show you here. Sorry, okay, what happened? Okay, so I'm gonna do this. So Ninja loans, okay, is no income, no job, no assets. Okay. Ninja. Ninja. So no income, no job, no asset. So for people who have no income, no job, no assets, they can get a house. Can you imagine? Can you believe that? So what happened is, in the 2006, if you remember, the oil company, the economy was very strong in the 04, 05, 06, 07. And so when the market started declining, what happened is, a lot of the buyers just walked away, right? So in the market, there are lots of houses unsold, right? Empty. And so that's why the housing market crashed. Just because the bankers doesn't care. In fact, they get a bonus based on the amount of mortgage they give out. The more they give out, they get more bonus, right? So they just go crazy for their bonus. You have no income, no job, that's fine. I can still give you a mortgage. You can still have a house. So then eventually when the economy is going down, the housing value depreciate, then the problems really reveals. And then the market eventually crashed. Okay?
Sorry, I have a question.
Yes.
So it's about, you talked about like the loan, can I call it the bankers getting more bonuses because they gave out more loans? And that's the case of tying performance, like tying the compensation to performance. So in this case, like you told us that one of the ways whereby you can overcome the case of moral hazard is to tie compensation to performance. But in this case, tying the compensation to performance led to the moral hazard.
Yeah.
So like, how do we go about, like, what is the right thing to do in this case?
Yeah, very good question.
This case?
Yeah, you are asking a very, very good question. Thank you very much. Tululup. How do I pronounce your name? Tululup? Is that right? Tululup?
Tolulokbe.
Okay. I'm so sorry. I'm not good at with names. I have to apologize if I didn't pronounce your name right. I'm so sorry. But I'm learning. That's why I'm trying to learn how to pronounce your name correctly.
Okay.
So that's a very, very, very good question. So remember we talked about the previous example. There are two parties, right? The CEO versus the owner, right? That's two parties, right? In this scenario, it's really about the buyer of the houses versus the insurance company. Because eventually this negative consequence is taken by the insurance company, not by the bank. Does that make sense?
Yes, to an extent.
So if the CEO is not working hard, the negative consequence is borne by the bank. if in a scenario only the CEO of the bank and the bank, right? If the CEO is not working hard, the negative consequence is borne by the bank, right? That's why the bank will use performance incentive pays to motivate the effort, right? But in this case, it's different. Right? The two parties is really about the buyer of the house versus the insurance companies. Does that make sense?
Please. Thank you.
Yeah, okay, very good.